Hey, what's up everyone, and welcome to the School of Personal Finance. So when I was a practicing financial advisor, I used to manage over $100 million worth of retirement assets. So that was in like everyday people's 401k plans, 403b plans, all different types of retirement plans. And I used to run around and enroll people and have these short meetings with them, trying to figure out what their risk tolerance was, how much they want to invest in their 401k, how much they need to save to retire. So I thought that it would be helpful if I kind of walked you through what one of those meetings looks like, so you could get an idea of the questions that I would ask and the mind frame that I would try to, put these people in when deciding how much they need to save for retirement and how they should actually invest that money in their retirement account. So let's get to it. So now these meetings were really geared towards just getting them enrolled in their retirement plan or reviewing what they had going on inside their retirement plan. So it wasn't a full financial planning meeting where we were talking about all the different aspects of their lives. It was really just focused on their retirement plan. So I had a specific process that I would walk people through. The first question that I would always ask them is, when do they want to retire, at what age, and how much money do they think they need in order to be able to retire? And now, having a pension or not definitely made a big impact on the amount of money that they thought that they would have to save for retirement. But some of the answers that I would get, were just completely off the wall. Some people would say, as much as I need $10 million in order to retire. And maybe that was true if they wanted to go, live in Hawaii on the ocean somewhere. But some people would say, hopefully if I could save up $100,000, I'll be able to retire at that point without a pension. So a lot of this first discussion was about, reality and what the numbers will actually be. So back in my previous video, Investing 101 with the financial calculator, I would break that thing out right away. And I'd be like, listen, if you save, $200 a month for the next 30 years, and that's it, you're gonna walk out of here with 350 grand if the market does well. Are you gonna be able to retire on 350,000 bucks? 30 years from now, the answer is a loud, astounding no. That's not enough money. You have to figure out a way to save more than that. So that would be the first part of this discussion, was what I would call the reality check. So then the second part of this discussion would be around risk tolerance and time horizon, how much longer they have to retire. A lot of people that I would sit with, they would be like, I just want to invest in the safest, most secure type of investment, like a savings account, or if there's a money market account or a short-term bond fund, something where I'm not going to lose my money, my hard-earned money that I'm putting into this account. I don't want to lose any of it. So this would be another reality check. I would show them using the calculator, listen, if you earn 2%, this is what you're going to have at the end. If you could get it up around 8%, it's a tremendously bigger number that you're going to have at the end of this. And if we look at the history of the market, if we look at any 30-year period, you always did better by investing aggressively. So I would have to embed in their brain that, listen, you have to take risk. You have to go for it, because honestly, it's not that big of a risk if you have a long way to retirement. So I would really have to educate them on this point. And it's such an important point. It makes all the difference in the world if you're going to be able to retire or not retire. You cannot invest in your retirement accounts and put it in very conservative options. It makes no sense. So even though markets go up and down, and that you're going to have a year where we're going to lose 40% in the stock market at some point during your career, when that day comes, I don't want you to call me in a panic. I would rather you call me and say, hey, could I invest more into my 401k now that the market is down so much? Those are the phone calls that I should be getting. It should not be the reverse. So when we have the downturn in the market, embrace it, add to it, keep going with it. But for the most part, just don't worry about it. If you have a very long time horizon, just don't worry about it. Invest aggressively. As you start getting closer to retirement, you start to dial it down a little bit to make sure that you don't get clobbered right before you start needing to draw some of that money. But when you're young, when you have a long time to go, I suggest that you're 100% in stocks inside of retirement accounts until you're around the age of 40. And then you start introducing some bonds and more conservative allocations, but only in small increments. So you should be very aggressive. If you're 30 years old, investing in the 401k, you should be 100% in the diversified stock portfolio. That's just what has done the best over time. There's no reason to do anything different than that. So after we talk about risk tolerance, then the third part of this discussion is around fees. Now again, in the previous video, I showed you how big of a difference it makes. 1%. If you pay 1% extra in fees, in that example, it was $200,000 less that you would have at the end of 25 years. That is a huge difference. So fees are very important. So when sitting down, looking at the options that you have available in your retirement accounts, sometimes you don't have great options available. You have to be able to sort it, be able to look through it by the expense ratio. You do not want to have funds that have a high expense ratio. If you're inside of your 401k, you have to be very careful to choose funds that you're not paying 1.5%, 1.25% to have some company, manage the mutual fund inside of your 401k. It's not worth the extra expense. So you want to have low cost index funds. Fees make a tremendous difference inside of these accounts, especially when you start looking over 25 to 30 years. It's a big number. And then the next part of the discussion is around asset allocation. How do you actually put a portfolio together inside your retirement plan that is right for you? So we talked a little bit about risk tolerance, we talked about fees. Now we actually have to pick the funds that are going to match that so that you're invested properly in your retirement accounts. And now some retirement plans will have what we call target date retirement funds, and those could be a great option. But when looking at the overall asset allocation, you want to be diversified. So you want to make sure that you have some small cap value, and all that means are small companies that are considered value companies. Small cap growth, those are smaller companies that are growth companies. Large cap, which are going to be like your Microsoft, Amazon, big established companies. Growth companies, technology companies, healthcare. You want to make sure that you're very well diversified. And sometimes it's hard to figure out inside of your retirement plan which funds do that. Like for example, the index funds, are my favorite way to go. If you have like an S&P 500 index fund, then that's usually a low cost fund that gives you exposure to all 500 stocks of the S&P 500 index. So those are going to be your larger cap stocks. And then maybe you have a Russell 2000, a small cap stock index fund. So right there you have your large cap and your small cap. Maybe you throw a little piece of international, maybe 10% will go into an international index fund. And you want to start putting the pieces of the pie together. But if you're uncertain about it, my advice is to go heavy in the US stock market index funds like the S&P 500. If there's a total stock market index fund, that's a good option for an overall portfolio, but you want to start putting the allocation together. You do not want to be 50% stock, 50% bonds when you're 40 years old. It's just too conservative. You have too long of a time horizon. I would always tell people that even when you retire, it's not like you pull all the money out and start spending it all. You take it out in drips and drabs, so you still have a much longer time horizon than just retirement. If you retire at 62, you're going to be drawing on that money till you're 102. So you have another 40 years. By the time we retire, who knows? We have artificial hearts, artificial, body parts. We might live to be 140. So who knows how long that money has to last us? You're better off investing in growth. You just have to be able to stomach that there's going to be some horrific times in the market like 2008, 2009, where it's going to be depressing. You're going to be like, wow, I saved all this money. I was doing so well, and I just lost 40% of it. And it's gut-wrenching and it stinks. But you have to realize those are opportunities. The only time that those will kill you is if you needed to take money out in 2009, 2010. Then it hurts. You can't put yourself in that position. But if 2008 comes around and you're not withdrawing money until 2038, who cares? It makes no difference in your life. It has no impact. All it does is give you the opportunity to invest at these low prices, which is exactly what 2008, 2009 turned out to be. So in these retirement accounts, again, be aggressive. Don't be bashful. Invest for the long term. Invest for growth. You'll be happy in the end that you do. And then I would wrap up these meetings with my words of wisdom, with my secrets to success, or some quotes that I would throw out there. And my number one, which I live by as much as I possibly can in all aspects of my life, is keep it simple, stupid. KISS. Don't make it more complicated than it has to be. Even in these retirement accounts, like if you have a good plan, then 3 funds is plenty. You don't need to have like this big diversified portfolio of 12 different funds with all this stuff going on that you have to rebalance once a year that causes you stress, that makes you feel like, oh, I need to get somebody to help me with this. 2, 3 funds, it works. You could do it that way. So keep it simple and don't stress about it. And don't look at it all the time. Don't worry about it. Just keep it simple and let it go. And then one of my favorite quotes is, time in the market always beats trying to time the market. So I would get so mad at people when they would call me up and be like, listen, I think the market's going to go down. There's this going on and whatever it is. There's a trade war going on. The market's going to go down. I need to get out of the market. That would drive me nuts because it's the wrong move. You cannot time the market. If we could all time the market, we'd all be rich, sipping margaritas on an island somewhere. It is impossible to time the market. So yes, you could have a gut feeling, and you'll hear about it every time somebody had a gut feeling and they were right. But you know what? If you have 10,000 people, you're going to get a few people that are right, and they're going to go on TV and talk about what a genius they are. It doesn't matter. Nobody could predict what's going to happen in the future. All right? If everybody guesses, somebody's going to be right, and they're going to let you know about it. Ignore the noise. Don't listen to it. It's impossible to time the market. And then another one of my favorite quotes, which I should probably make like the motto of School of Personal Finance, is an investment in knowledge always pays the best interest. And that was Benjamin Franklin. So that is an awesome quote that I love as well, and I would always say to people. And another one that I love, when you invest, you're buying a day that you don't have to work in the future. If you look at it that way, it makes it very easy to start investing now. Every day that you're investing, all you're doing is purchasing freedom on the back end of that. So the more you invest now, the more freedom you have, in the future. So it's good to start investing now. And then my last of my favorite quotes is that wealthy people invest first and then spend what is left, while broke people spend first and then invest what is left, which is usually nothing. So invest first, spend what's left over, do it for a long period of time, and you'll eventually be wealthy. All right, that's it for this one. Please subscribe to the channel if you've not already. Keeps me motivated, keeps me wanting to make more and more of these videos. Hit that like button if you enjoyed this one. Please friend me on Facebook, follow me on Instagram, Twitter, LinkedIn. I will see you again in the next video. Thanks a lot.